g'day, Fred. How are you, mate?
Yeah, good, mate. Yourself?
Yeah, not too bad. It's a pretty hot one down here at the moment. How are things over there?
Yeah, well, pretty good, but everyone's probably aware of the fires we've got out here, so we've had a bit of a reprieve from that, so hasn't affected us directly.
Yeah, either with us. My farm got copped down in New South Wales, but luckily it was just land and fencing that got hit, but all the infrastructure was burnt down last year, so there was nothing to burn down this year.
Yeah, let's hope it eases up for everybody. It's pretty dramatic.
I feel sorry for a lot of people. There's a lot of people in angst at the moment.
Anyway, so what are we talking about tonight, mate?
Look, what I thought we'd do is we'd make it a fun session tonight because some of our prior podcasts, they're fairly technical in nature. So I thought that what I'd do is focus on a few walkthroughs where we can demonstrate a couple of important responses to some of the queries we're getting from our members in relation to whether or not the strategies might be curve fit or other issues like what are the impacts of the different methods of testing your strategy using tick data or open and control points, and what is the impact of slippage with our strategy. So I thought this might be a good session to make it a bit fun and demonstrate some of the things that we've found, which hopefully make our members happy with that we're responding to their queries.
Yep, good. Let's do it.
So, look, what I thought we'd do is we'd start with a comparison of our test results on one of our standard strategies. So in the last couple of podcasts, we've gone through the technical details of how we are designing and developing these strategies and the techniques, but this is an example of one of our strategies, which is the Euro USD, which is traded on the daily time frame. And on the left-hand side of the chart, you can see that we've tested this using tick data with 99.9% accuracy. And on the other test, we've tested it using open prices only over the same date range on Pepperstone data. Sorry, one's using Dukascopy data and the other is using Dukascopy data with the open prices only. And you can see that the overall results of both strategies are very similar. They're not what we'd regard as materially different. So when you look at visually the equity curve and you look at the blue line, which is the realized equity, and the green line, which is the floating equity, you can see that both charts using either method are very similar. And to look at the actual variation, if you come to the total trades, you'll see that on the tick data we took 292 trades, and on our open prices only we took 303 trades. Now the net effect on our overall profit with our tick data was a profit of $137,659, but over with our open prices only it's $139,231. So the actual variation in terms of net profit is only around 2,000, and in the terms of what profits these strategies are generating, we wouldn't regard that as material in nature. It's probably only about 1% or so or less in variation. So what do you think, Fred? Anything you like to say?
The thing to remind everybody is that the EAs that we've written are written to make a decision on the open of a new daily bar. So it doesn't matter what the tick activity is during the day. We're only making those decisions on the open of the bar. So that does a couple of things. One is it guarantees that we have open prices and they're fixed. We're not subject to variations of MT4 making decisions as to what the tick data look like. And it also speeds up the testing process. So what you're demonstrating there is there's no need to test on tick data or control points, not with our strategies anyway.
Yes, and one of the reasons we prefer the open prices only, not only due to the fact that there is a limited material variation, it is so much faster to process our back tests using open prices only. So
the other thing to realise here is that in order for MT4 to generate tick data, it needs to have the 1 minute data, the 5 minute data, the 15-minute data. And if you're trying to trade from 1995, for example, it's pretty rare that you're actually going to have 1 minute data available. So you're kidding yourself if you're trying to test anything on tick data more than the data you've got available in your 1 minute chart.
Yeah, great point. Great point. So look, that's a variation between the different methods. Now, what I'd also like to show you is the variation with the impact of slippage applied. So I'll just move this tick data example off, and I'm going to bring over here an example of testing the strategy using double the spread that was applied in the original test. So in this particular test with Dukascopy, we already conservatively double the spread when we undertake our tests. That's to take into account of the fact that spread varies over the course of the day, so that the spread that you'd observe during the active sessions it tends to be lower than the spreads during the more inactive sessions, or you can also get news events, etc., which widen the spread quite dramatically. So we already double the spread when we undertake our back test, which is represented by this particular strategy here. So in this example,
could I just interrupt? Sorry to interrupt you, mate. You keep referring to it as Dukascopy, but if I read your heading there, it's Pepperstone. So are we on Pepperstone or are we on Dukascopy?
Yes, it was actually tested using the Pepperstone platform, but it's using Dukascopy data.
Right, gotcha.
I'll show you what the way that happens when we get to the actual test. So this is actually using Dukascopy data. So all of our design of our particular strategies we've undertaken on Dukascopy data, but we actually trade these on Pepperstone data. So this test on the right-hand side, we're testing on the Dukascopy data using the Pepperstone platform. That's why I've got Pepperstone here. But we tested using double the current spread that we observed during the time we're undertaking the test. So in this case, we're using a 20-point spread on Euro USD. And on this table here, this is looking at an impact of 40-point spread. So the assumption here is that we're testing the impact of slippage on our trades, assuming that every one of our trades undertaken possessed double the spread of our testing environment. Look, it's just a method of conservatively estimating slippage impacts and what is the material nature of it to the strategy. So when we actually apply a 40-point spread in this left example, we see that total net profit is 138,763 versus a total net profit with no slippage assumptions of 139,231. So once again, we wouldn't regard that as material in nature, and therefore we're very comfortable with the fact that for these particular strategies we trade, which are very long-term in nature, have relatively few trades, even though these trades, for instance, in these examples, this had 303 trades and this had 302 trades. The low number of trades and the impact of slippage is very low. Now, we're not saying that this is always the case. When you get down to, the M30, the M5 and the M1 timeframe, slippage becomes a very big issue. Also, the difference between the tick data and open prices method. Now, while Fred codes the open prices only on the entry, the exit can vary based on where the trails are triggered out, which therefore you can get a degree of material variation in the low time frames with the method of testing. But with our D1, we found that it's immaterial in nature. So any points you'd like to raise, guys, with that?
Yeah, I'd just like to also clarify, when you see your parameter set up there, it might appear confusing. We're talking about testing the euro, but we can see all sorts of other instruments there, the Aussie CAD, the Aussie Swiss, etc. And the reason for that is because the strategy that we've created here is a multi-instrument strategy. And in this particular instance, we're only testing the euro as is identified by the top line there, which is the euro. But just to clarify that while those are there, it's not really impacting this particular test.
Excellent. All right, so now I thought we'd get on to the fun stuff. Now, as we've mentioned to you, we test these strategies and design and test them on dukoscopy data, but now we want to test whether or not they are curve fit. Now, in our prior podcasts, we've already given a number of clear reasons why in our particular process we undertake, we take every measure we can to eliminate the possibilities of a curve fit result. But we thought an actual example using unseen data would clearly demonstrate that they aren't curve fit. So what I'm going to do now is I'll just show you the date range that we undertook the testing on. So I'm now going to bring over my dukoscopy tick data, and we'll go to Euro USD, and I've highlighted it here. You can see that the test data was supplied from 4th of the 5th, 2003. Now, for these particular strategies, we need to add 4 years to that commencement date so that because of the long look back that we apply for donkey and brake indicators, sometimes up to 750 days back, we need to ensure that all of our particular combination of donkey and look backs can be activated from day one that we commence trading, because otherwise we'll find that only the shorter term Donkians activate first, with the later term Donkians only activating as the data reaches that point where we have that sufficient look back for that entry to occur. So for our testing purposes, even though the data range here for dukoscopy says we have from 4th of the 5th, 2003, we add 4 years to that. So it's actually, we start the test range on the 3rd of the 5th, 2007 by adding 4 years. That therefore ensures that all of our indicators in our strategy set will be active right from the outset.
Rich,
so go for it, mate.
You might also need to just clarify what it is you're doing there, because this is not native to MT4. What you're dealing with here is tick data available external to MT4, and you're importing that data in. But a couple of words on how that works might be advisable.
Yes. So we're using here Tick Data Suite, which there is a cost to it on a monthly basis, and we can access data from a range of different brokers here, such as Dukoscopy, TrueFX, Alpowery, a range of different particular brokers, and that gives us tick data for all of these brokers. Now, we use Dukoscopy because the date range available for Dukoscopy is much longer than these other broker types, and also Dukoscopy has similar GMT offsets to our Pepperstone broker, which we use on our live trading account. So this data is adjusted, the Dukoscopy data is adjusted to a GMT +2 on our testing to align with our Pepperstone broker timeframe. Now, the reason that's important is when we say that we trade off the open bar and we're dealing with the daily bar, we want to make sure that the same time of open occurs on the different broker data sources that we use. So in this case, when we're using Dukoscopy, we want to make sure it's aligned with our Pepperstone. Now, for our design and testing, we therefore have mentioned we add 4 years, and therefore we've tested this and designed it from 2007 through to 2019. So now what we want to do is look at that strategy using Pepperstone data. So over here, you'll see we have a little box called Use Tick Data. If I click that, I therefore am using Dukoscopy data, which we've discussed previously. If I untick that, I'm now using the native data from my broker, which in this case is Pepperstone. And just to explain, with the Pepperstone, I'm just bringing over a database here, which is where we've input all of the design specifications of our particular date ranges for our particular instruments that we're testing. So with Euro USD, our Pepperstone data we have is from 10th of the 6th, 1991. Now, once again, we add 4 years to that. So we can actually test from 9th of the 6th, 1995, going forward to current day. So I'm now going to set that date to 9th of the 6th. Sorry, what is it? It is 9th of the 6th, 1995. So
the important thing to note here is that the EA and the testing we've done commenced something like 10 years past this date. So this date range we're looking at now has not been seen by this EA, and it's not been featured in the development of this EA.
Yes, just to clarify that, we're testing here on Pepperstone unseen data from 1995, and if you remember when we told you that we designed this data using duchoscopy data from 4 years from 2003, so from 2007. So in this case, we have got
12 years.
12 years of unseen data. So now we want to therefore see if the impacts of this are curve fit. Now, what we mean is typically with a lot of data mining solutions that you might find on the marketplace, when you undertake detailed testing and you have a particular solution which has been data mined over a time series, as soon as you implement that solution into a live environment, performance significantly deteriorates. Now, that is an impact associated with a curve fit response. Now, in our prior podcast, we've explained how we avoid that with this technique. So if we have a solution over this level of unseen data, how many years is that? Sorry, Fred, I forgot it. We've got
12 years extra, yeah.
12 years extra. If we find it's not materially affected, that's a good sign that we don't have a curve fit response. So in this case, I'm using the date range from 1995, 06, 09 up to current day, 2020, 01, 08. I'm putting the spread at the current, well, double the current spread. So if we look at the spread of Euro USD currently, it's sitting around 13. So let's say it's currently sitting at 12 or 13, let's say 13. Let's make that spread double, so 26 points in our spread. So now we've got our date range, we've got our spread.
Turn your visual on, mate.
Oh, thanks, mate. We're testing with $1 million start balance. We don't know what we're going to get, but we're just starting with $1 million. And I'm going to turn my visualization on, and I'm also going to give a maximum screen here. And I'm just going to put my visualization on a bit slow so that when we run it, we can map the equity curve result against the trade result. So let's start with Euro USD. So here we go. We're now starting the EA, and I'm going to flick to the equity curve. And now, Darren, Fred, as this is going through, we'll discuss it as it's moving through. It's probably a bit slow at the moment, so I'll just speed it up a bit more. And yeah, let's discuss it. So up here, we've got the visualization of the trades over the data. So as you can see now, this is back in 1995. We've got, I'll put the date here. So as we can see, you know, from 1995 through, we're currently 1998, we've got a nice short run here. And we can see that what happens with this particular EA, it's using a large number of solutions, as we've discussed in prior podcasts, which have different variables applied to, or different combinations of variables applied to the solution. So in this case here, we're now up to 2001, and we can see that our equity has now lifted by $136,000 with this lovely short. Now, this is on unseen data. So it appears that the strategy is working well. And this is catching a superb outlier move. When we talk about an outlier, if we look at the blue line here, this is the realized balance line, and the green line is the realized, so the floating equity line. You can start seeing how the equity, the impact of these outliers is so significant to the P&L, and in other times there isn't much deterioration in the equity when it's not in these outlier periods. So It's holding up well. Now we're in a very nice long period. So, guys, I'm just going to shut up for a bit. You guys talk as we're discussing this.
Rich, can I ask you a question about, you just said about there's limited deterioration in the balance.
Yes.
But we're clearly opening a lot of positions there.
Yes.
So obviously that's being covered by the much shorter trailed positions.
Yes. So we've got a combination of variations. Fred, do you want to just go through some of the combinations? Like they're fairly broad.
Yeah, it's a little bit hard to visualize, but each one of those lines, those red lines and green lines, is indicative of one trade. So at the moment, we might have 4 or 5, 6, 8 trades open at any point in time. The longer the line remains on screen, the longer it's in play. So what you'll see is at the moment, if you just pause that, Rich.
Yep.
We've probably got, if you count you can count the horizontal lines there as well. We've actually only got 2 trades in play right now, 2 or 3 trades in play. You can see where the trailing stops are. So we're taking small losses and we're letting the winners run, and that's how we can achieve that sort of result.
I'll just step back a bit, just over some of that past history, so you can clearly see these lines here represent the trajectories of each of the solutions. And remember, we talked about a machine gun approach, which adopts different trajectories. So, Darren, this sharp trajectory here would be a short period Donchian, and this very long trajectory here would probably be from a long period Donchian with a wide trailing stop. But overall, you can see how some of the trends, some of the variations get snagged out. This one gets snagged out here, but it gets reopened up here again, if you can see here, this small segment here. This one here gets snagged out at this point here, but then gets reactivated for this segment here. This segment here gets snagged here and gets reactivated for this segment here. These segments never got snagged out. They just went the whole way. But of course, with their wide trail, when the trend ends, clearly we lose a lot of profit off the table. But that's reflected in the graph here, where you can see how our realized equity gets to, in this case, we're almost up to $435,000 here, but we're prepared to sacrifice that to a degree. But we can see that our drawdowns aren't significant. So our drawdowns are based off our floating equity as opposed to our realized equity. And you'll see that with the overall trajectory of this realized equity, our drawdowns aren't significant. At the end of this test, we'll be able to see the actual total relative drawdown we've achieved. But that's an example of that long period, and this is a lovely period of this machine gun approach to entries using shorts. So we are now at this point here. Remember, this is all on. So up until I think it was 2007, we were all on unseen data, and on that unseen data, we got a magnificent lift of our equity curve. So this curve here, this was in 2003 at this point in time, which is representative by the values of the floating equity and the realized equity balance here. This is 2003. This was all unseen. So all of this was a result of applying this strategy, which was developed from 2007 onto a past period of time that commenced back in 1997. We had a superb run right up to a peak in equity at around about 2000, from 1997 up to 2000, the 3-year run, a beautiful short trade with a range of different solutions. So this represents this period here. And then we notice that when we exit out of these very long holding period short trades, you'll find that we've got long trades already activated going the other way if the price starts bouncing back up after a very heavy downturn. So if you could imagine, we had a very nice downturn or a bear market at this point here. our trends ended at a delayed point when the trends were cut off by price at this point here. But then we had long trades commencing before all of our short trades were closed out. Now, there is a bit of hedging going on in this zone here, as we have some short trades still active, but we've got long trades entering. So the loss we're incurring in our short trades by having too much profit on the table are being picked up by realized or unrealized profits in our long trades before we get to our last short trade, which is closed out at this point here. So at this point here, we've already got some nice floating equity from our longs at this point here. And as we go forward, we get another lovely long trend. So I'll keep the strategy going.
The other thing to note here is that when the realized equity and the unrealized equity come together, that's the time when we've got minimum trades on the table.
Yes, good point.
Like as right now we've got one, now we've opened a few more, and you can see those two lines are tracking together. And in periods of sideways movement, we're likely to take small losses as we move along, waiting for the next big trend to kick off.
And what Fred's talking about here means that when we have these slow building drawdowns, you can see there is only a very slight deterioration of overall equity. That's during unfavourable market conditions. But now look what's happened. We're now in 2014, a superb outlier. We know about this one. And our equity is now taking off again. So now we've got a large number of trades on. What Fred was saying, during these ugly times, we've only got a few number of trades on. But now we're fully engaged in this beautiful short period. And you can see now we're starting to get some longs coming in. Now they're going to start getting some realized profit, so we don't lose as much off the table. But now we're reverting back to some of our long trades and, our short trades. And we've got some nice long holds here on some of our short trades. And we're getting very close now to current day. So we're almost there. Okay, so we've now closed off everything. So at this point here, our realized balance now meets our floating equity, but under normal conditions, we'd keep on trading this for as long as it takes. We don't know which way it's going to go, but if it keeps on going down, we'll just continue to benefit from the short trades. But now have a look at this equity curve. So you can see that overall, there are two significant periods or outliers that have significantly impacted our P&L, and they are significant in nature. Now, most retail traders are trading this sort of stuff, and they're wondering why trend following doesn't work. There's a couple of things you might hear on the forum. Firstly, they say, well, if you have an EA, none of them last more than 3 years. Well, here is an example of something that's lasted from 1995 and delivers superb results. So that the myth of the 3-year might be applicable for particular types of strategies, but it certainly isn't relevant for trend following. So with this particular style of trend following using the Donchian breakout, you can see that our fortunes are made with these outlier periods. So we've only had 2 over this entire period that are significant in nature. And this means that this particular style of strategy is not a cash flow generator, it's a wealth builder. And the way to understand that is you cannot think in terms of whether this is going to generate X% return per month. We don't know what this is going to generate. All we know is that if we have these favorable outliers, our overall wealth is going to skyrocket. So this is one example using Euro USD. Now imagine this example using 30 different markets. The outliers will occur in all different regions, and overall we're going to get a bonanza result when we compile all of those separate different solutions for different markets together into a portfolio. And so look, I'll just jump to the report. Let's have a look at the overall performance. Now this is from 1995. Our profit factor is 2.56. That's a pretty stunning result. I don't think many people with EAs get that level of profit factor regularly, especially not over such a long time frame. We can also see that we've had 434 trades in total, which is quite a large sample size for this single market. We can see that we've actually had 67% of our short trades have won, and 9% of our long trades have won. Now, there is a reason for that, because in our prior podcast, we talked about how we trade positive skew or an adjusted trail technique. We won't go into the reason now, but you need to refer to prior podcasts to understand what we mean. But this is why a dominant number of trades, we have 329 trades being short, and we only have a much smaller level of long trades. And that's because when we look at Euro USD, and I'll just show you, Euro USD in this case has a short swap, a positive swap of $6.90 per lot. Now, this is the current swap rate, and we've got to remember that over the course of the backtest, this rate will vary. But in this case, we have a positive swap of $6.90, but on the long trades, we've got a negative swap of -12. So on this strategy, where you see we have short trades, you can imagine that they're also benefiting from the positive swap here. But where we have the long trades, we use an adjusted trail technique described in other podcasts, which basically ensure that if we're holding these positions for a long time, we subsidize the negative build of our swap with a tightening trail, which therefore offsets the impacts of the costs associated with the holding period. But other things to look at the average profit trade. It's $2,955 versus an average loss trade of minus $1,313. So you can see that we've got around a 2.4 times reward to risk here, and we have clear positive skew. We've described that in our prior podcast as well, which is very good. Now, another way we can see that we have positive skew is when we look at the equity curve, you will see that our floating equity always sits above our realized balance. With negatively skewed system, the reverse occurs. The floating equity sits below the realized balance. So this is a clear indication that this strategy has strong positive skew. So that's an example of Euro USD. Guys, anything you'd like to bring up?
Well, it's just, for me personally, it's just very impressive, from years of trying to automate these kind of systems. It's really impressive results that this strategy produces. And there's probably nothing really revolutionary in here, but I think you guys have kind of nailed down a few elements that are really important. And yeah, really, really impressive stuff.
One of the things that you might hear a lot of anecdotal statements made by people that Forex never trends. Well, here is an example from 1995 through the current day of Euro USD, which does trend clearly. And what you find is this particular method we're applying to catch the outlier means that we avoid the noise of the normal ranging market condition. We're only taking our trade entries when we get a significant price move away from the normal noise of the market. So when you get clear of that noise, you can see that, yes, trends are viable, trend trading is viable, but provided you extract yourself from the normal daily range of the market and only take trades in a more selective condition outside of that normal range. Look, I'll step into this just to ram home now an even longer back test. So GBP USD, we tested from, once again, 4 years from 2003, from 2007 through to current day. That's our design and testing using Dukascopy. Now on Pepperstone, we've got a fantastic range of data here. So for GBP USD, we've got from 4 years from 1978, which is from 2nd of the 1st, 1982. So let's see how that goes. Now, in this case, Fred, you might need a calculator here, but can you calculate from 2007 to 1982, what is the outer sample range we've got here?
A long time.
I think it just demonstrates it. It's well over, it's about 30 years of unseen, isn't it?
25.
20, yep, so I'd say 25. So 2nd of the 1st, 1982. So I'll just put this in. 2nd of the 1st, 1982. We're using GBP USD. Just going to. So 1982 up to current day. We'll just check the current spread. The current spread is, say, 15, 16. Let's say it's sitting at 16. So we double that spread to 32 points. So that's a conservative estimate of spread, which also takes into account degrees of slippage. And now let's run that and see if this is curve fit. So here we go. So we're running. So now we are back now at 1980. We commenced here in 1981. We immediately go into these shorts. Now, the thing is, if we'd entered up here, if we'd had a bit of longer data, we'd have been entering at about this point here and getting an even better result. But already you can see our equity has now gone up. Well, in this case, it was up close to about $200,000 from $1 million start. We're now up to close to well, at this point here, we're $430,000. So we've had a magnificent trending period here. We're now in a long phase. So this is just demonstrating that no matter what data we're putting this on, we're getting amazing results, which is testament to the fact that there is no curve fitting in these solutions.
Yeah, this is usually where you see your EA fail, isn't it? A great result on one instrument, and then you switch to a new instrument and it's almost a polar opposite.
Yes. So we had a short period, we had a nice long period.
And these outlier moves, they're not really, you couldn't really call them black swan events. They're just kind of...
Yeah, they're more indicative of they're more indicative of the price moves you see on the monthly charts, as opposed to the price moves you see on the daily chart. So if we look at what type of moves are these catching, you'll find that they're the long secular trends, as opposed to the minutiae. We're only concerned with the big moves. So if we have a very sharp, big drop like we're getting now, very sharp drop, we catch that. That's an outlier, which is a sharp move. But sometimes we have very long, consistent trends over 10, 20 years. We catch all of them. I'm just about to show you after this some of our indexes, and you'll see what we mean. We get amazing results on our indexes. At the moment, we're testing Forex here, so GBP USD. You can see how we're up to 460,000 in equity, above our $1 million starting balance. The drawdowns aren't building quickly at all. It's very slow decline during unfavorable periods. But during these outliers, we get these monumental moves, such as this period here. And visually up here, you can see we're up to 1997 now.
The other thing to note is that the timing of these events is different from the euro. So that's where the portfolio compilation comes into account, where you're adding together different equity curves to smoothen out the overall transition from go to woe.
You can see that it's been an unfavourable period right through here, but the decline has not been a significant disruptive decline. There's been a slow progressive decline, deterioration in equity, but we're still holding fairly high equity of 280,000. Now you can see now this is going to be lifting our floating equity with this nice short move here. And you can see floating equity, it's just starting to show on the chart, is starting to lift up again. So you just got to be patient. We're not forcing an outcome from the market. We're waiting for the market to deliver these to us. That's one of the key things you've got to remember. It's the market that delivers your profit, not your system.
It kind of highlights as well why this idea of using discretion really is just ridiculous, because these movements evolve over such long periods of time. The ability to be able to predict that in a short period of time that's going to occur. I mean, nobody can do that. I mean, unless you're Spock or something.
No. Well, for a start, we've got 20 solutions here in this single EA. I don't think a discretionary person is going to be able to manage 20 different solutions. Secondly, you're right. We're dealing with the long term here. This is out of the zone of discretionary trading. Look at this magnificent long trade. That's
a thing of beauty, mate.
Absolute thing of beauty, mate. Now we're getting the benefit of these shorts now. Look at that. So we're capturing these sharp moves, long or short, where we tend to sort of stagnate or have slow progressive drawdowns is just during these market regimes that because we trade outside the noise, price still has to do a fairly big move to get into our zone of interest, but they're false breakouts. That's when we get the negative results. But now you can see our equity is clearly starting to lift quite considerably again. We're up to 2011. Now, there's not many people I know that could give you a back test from 1983 to current on an automated solution that survives and prospers.
Yeah, well, the general consensus out there is that it's not possible.
Yes. I'll just speed things up a bit because I do want to get to the index. I've got others, but perhaps we won't have enough time. But at least this.
It's proof of concept, mate. You're showing people that it's possible.
Look at this magnificent short. This is now all of the trouble with Brexit. We're now, this is the Brexit blues. But look how we're cleaning up with these shorts. Look at our equity soaring.
Nice. It's quite, interesting to see quite how much room you're given a lot of these positions as well to be able to capture these long sustained trends. I mean, generally when you're kind of building these strategies, you might consider you're giving your positions room, but clearly there's much more noise than we imagine.
Yes, mate. Yep. I'll go to the report. So look at our total relative drawdown. The maximum drawdown we have is 20.94%. That's more than livable with. But we've got a profit factor of 1.96 over this however many year period it is. 699 trades. Overall win rate, short positions won 60%, fairly high again. Long positions won 10%, but we have many more shorts than we have longs. Once again, we've got a positive swap on our short positions. Average profit trade 3,430 against an average loss trade of minus 1,420. Once again, we're getting around about a 2.4 reward to risk ratio here. Positive skew. Positive skew, you can see that the floating equity always sits above the realized equity. So I'll quickly now go to indices like the US 30. I've just got to see what date range I'm dealing with here. So the US 30 is an index, and I can trade that from 4 years from 2008 from my available data. So let's go from 6th of the 8th 2012. So 6th of the 8th, 2012, US 30. I'm just going to get the spread on that. The spread is 24. So let's go 48-point spread. And now we all know what the US market has been doing. So we know it's been a big bull market, but let's see if this EA can capture it. Here we go. Racing now. Right, we're already long as we're going up. Long. I think this is going to be a story of longs.
Oh, yeah.
Now, interestingly, our data mining was a much later event, but once again, it works. When I say data mining, the period that we designed the strategy on was using data, which was a much shorter range. So I shouldn't use the word data mining because it confuses people thinking that we've actually used a data mining process to generate this. We haven't. We've used the design process to generate these strategies. But look at this beautiful long position. Now, remember, we got long here back in 2012. We're still long. We got cut off with this whipsaw here. Still making slight profit on these trades here, but they've re-entered now at this point here. And we're in a beautiful long position. Now, our equity should just continue to rise and rise and rise. So we're up to 2018. Look at our equity at this point here. We're up to 315,000 in equity now over this long hold. There you go. So there was we had very few actual trades on this one. We actually had 119 total trades, but look at our profit factor, 7.26. Does that make the eyes water?
Yeah.
And short position. Now, our indexes, as discussed in our prior podcast, are long only. So there are no shorts. That's why there's 0% short positions won. They're all long. But we've had a 31% win rate on our long positions won. Our average profit trade was $12,217, and our average loss trade was $759. So look at the reward to risk on that. So once again, now I could do this across 30 different markets that Fred and I have currently been working on now, and the story is the same. So now you've just got to imagine Fred and I are closely working further on this project, trying to get these into a position where we can get our forum members to actually start using this. But Fred, let's discuss some of the things that we're working on now.
Yeah, one of the questions that was raised the other day is something that's obviously been close to our heart, and that is, what account size do you need to actually trade this beast? And while our testing is done on big numbers, and the reason for that is that we can get some granularity in our lot sizes, the idea is that eventually we will scale this back down to something reasonable. What that reasonableness is, we're not sure, but it might depend on your ability to fund an account. But instead of trading across 50 or 60 instruments, maybe if you've only got a small account, you'd need to limit yourself to a handful of instruments rather than a full gambit. So we're trying to work that through and see where that works. The other thing we're playing with at the moment is trying to optimize the number of EAs per instrument. Most of the testing you've seen here is all around 20 EAs per instrument. But that was just a starting point. We're not sure whether that's an optimum number or what that is, but we're looking to see whether more or less gives us better outcome. The current thinking is that if we can get away with fewer trades or fewer EA combinations, maybe 5 rather than 20, that'll allow us to trade a broader scope of the markets. So that's the sort of stuff we're looking at.
Yeah. I've just put on while we're talking. I've just put on gold to just show how our strategies work on gold. This is just running through now. So Darren, any thoughts, mate?
Yeah, I I thought what Fred was just saying then is quite interesting because you wonder whether say you've got 4 solutions that are roughly around the same parameter settings, whether that can be cut down to 1, and whether that reducing the diversification would affect it. It'd be interesting to see the results of that. But overall, I think it's really fascinating the kind of few core simple ideas that this is essentially working on. And correct me if I'm wrong. So really it's a case of not jumping into trends too early, using diversification with the way the exits occur, and giving trades generally much more space than we normally do. Would you say that's correct?
I'd say one of the if we look at our entry, we've got diversification of entry because we have a wide look back, but it starts from say a 50 period Donchian break or a 100 period Donchian break, but then we've got levels up to 700. So as discussed in our last podcast, that effectively is a bit like pyramiding, but each of the solutions has its own unique configuration. So there's diversification in our entry. We've got diversification in our exit with our different trails. So when one gets snagged out, another can continue on. So unlike pyramiding, where you might get 5 different trades on a single trajectory, when that trend ends, all 5 trades end. What we've got is 20 different variations.
Yeah.
The other thing, Darren, you were saying we're giving it a lot more room to breathe. That's true once the trend takes off, but in the initial phases, we're looking at a fairly tight initial stop loss. So we're not giving it room unless it starts to take off. So we're cutting them off pretty quickly if they don't take off. But when they do run, we give them some room.
Yeah, so I'm just kind of trying to nail down the kind of really the key elements of the strategy, kind of distill it down into simple ideas. And, maybe it's the diversification, that kind of, spreading out over different parameters.
Yes, so the more diversified means that you've got a more diversified array of uncorrelated or lesser correlated return streams. So it's spreading your risk.
Yeah, so going forward, if the market changes slightly, that shouldn't affect us too much.
Yes, well, we can see with these examples we've shown over 20, 30 years, 40 years or whatever, that no matter what market conditions are thrown at us, when adverse market conditions are thrown at us, we're not trading much. We've only got a few solutions ticking away. But when we get into favourable solutions, we accelerate our trade frequency. And you can see that this is a good example, for instance, how gold's finishing off currently. This is, the Iran spike we can see going up here. We don't know where this one's going to go, but we can see that we're favourably positioned in gold with a long move here. But diverse entries at these different points here, we're long. So, yeah.
And it goes quite a long way to explain why these single solution EAs tend to always fail, because this is an element that they rarely include. Would you agree?
Absolutely. A single solution, well, you can't really beat what we're doing here unless, as a discretionary trader, how would you couldn't apply this technique as a discretionary trader. This is fully systematic, and we couldn't manage this in a discretionary way if we tried. So unfortunately, as a discretionary trader, you're very limited to navigating a particular singular trajectory. You focus your effort on a correct entry, preciseness, trying to navigate that particular trajectory with exactitude. We're totally on the other side of that spectrum here. We are in the law of large numbers, we're applying a large numbered solution to our trading.
Yeah.
So guys, I thought we'd finish off here. Anything else we'd like to comment on?
I just thought it was the best podcast yet, guys. It's really good to see visually what we've been explaining over the other podcasts.
Yeah, what I'd encourage our members to do is to ask questions if there's something on here they don't understand, because we're so deeply ingrained in what we're doing. We're making lots of assumptions that people know what we're actually talking about, and so if there's something unclear that needs to be asked, then we'll do a podcast on it and make sure everyone's on board with understanding what we're trying to do.
Yeah, definitely. Give us some feedback, guys.
All right, gents. Well, thanks very much, and thanks, listeners. We hope this has been a bit more of sort of a light-hearted look at trading. We've had some pretty technical ones in the past, but this is a bit more exciting. So, and it also just demonstrates the power of what can be achieved from trend following using a diversified, systematic approach, particularly on Forex markets, which a lot of people don't think trend, but we clearly can demonstrate they do trend. So thanks, guys, and see you next week.
Thanks, Fred. Thanks, Rich.
Cheers, guys. See you later. Bye.